There is a weird trap in the $10,000 cash rule. The trap is not that the bank files a report. That part is normal. The trap is what people do because they are scared of the report. They split the money. They make two smaller withdrawals. They pay in pieces. They tell themselves, this looks cleaner. And that is where a simple transaction can start looking suspicious for the exact reason they were trying to avoid suspicion. That is the part most people get backward. A lot of content about the $10,000 rule gets sloppy fast. It turns a real rule into a horror story. It mixes banks, taxes, crypto, Venmo, cash, senior fraud rules, and criminal law into one giant panic cloud. And when everything sounds dangerous, people do the worst possible thing. They start improvising. They start moving money in strange ways. They start asking the wrong question. The question is not, how do I avoid the report? The better question is, how do I move my money in a clean, boring, easy to explain way? Because in this world, boring is your friend. The Bank Secrecy Act does require financial institutions to report cash transactions over $10,000, counted by daily aggregate amount. That does not mean you committed a crime. It means a report was filed. The problem starts when ordinary people treat that report like a criminal charge. That fear creates the behavior that actually gets attention. The first thing I would strip away is the drama around the number itself. $10,000 sounds huge until you live in the real world. A used car can pass that. A roof repair can pass that. Medical bills can pass that. A family gift can pass that. A small business cash deposit can pass that. So when people hear, the bank reports cash transactions over $10,000, they imagine some secret alarm going off. That is not the right picture. A currency transaction report is paperwork. It is part of the banking system. Banks have to file it when cash transactions cross the threshold, including multiple cash transactions that total more than $10,000 in one business day when the bank knows they belong to the same person. That report does not mean the bank thinks you are guilty. It does not mean the IRS is waiting outside. It does not mean your money is illegal. It means the system wants a record. And yes, that can feel invasive. I get why people hate it. But the report itself is usually not the danger. The danger is when someone thinks, I'll just keep every transaction under $10,000 so nobody files anything. That sounds cautious. It can be the exact opposite. This is where the rule becomes less about the number and more about intent. If you need to withdraw $12,000, withdrawing $12,000 is not the strange part. The bank may ask questions. They may file a report. They may verify your identity. Annoying, yes, but clean. The strange part is walking in today for $6,000, walking in tomorrow for $6,000, and doing it because you are trying to stay under the reporting line. That is the word people need to understand. Structuring. Structuring means breaking up cash transactions to evade reporting requirements. And the money can be completely legal. That is what makes this trap so ugly. It is not only about dirty money, it is about the reason you broke the transaction apart. The IRS manual says structuring can include breaking down a sum over $10,000 into smaller amounts, even across more than one day or more than one financial institution, if the purpose is to evade reporting. It also says structuring is illegal whether the funds came from legal or illegal activity. That is the part people miss. They think clean money keeps them safe. Clean money helps, but clean money plus strange behavior can still create problems. And no, two transactions below $10,000 are not automatically structuring. That matters too. The FFIEC gives the example that two deposits slightly under $10,000, days or weeks apart, should not simply be assumed to be structuring. The bank has to look at context, history, and the reason for the activity. So the rule is not, never make two smaller transactions. The rule is much simpler. Do not break money into pieces to dodge a report. That is not clever. That is leaving fingerprints on the part of the story that did not need fingerprints. Now let's talk about the bank questions, because this is where people start feeling insulted. You ask for a large withdrawal. The teller pauses. A manager comes over. They ask what the money is for. They ask if someone told you to withdraw it. They ask if you are sending it to someone. They ask if you recently got a strange phone call. And suddenly, you feel like a suspect in your own bank. I understand why that feels wrong, but there is another side to it. Banks are under pressure to spot fraud, especially against older customers. That pressure is real because elder financial exploitation is real. Federal regulators have said banks may use transaction holds and delays when state law allows it and when they suspect elder financial exploitation. Some state laws also give banks immunity when they meet certain requirements. This is where the system gets uncomfortable. If a bank releases money to a scammer, the bank may get blamed. If the bank delays a real customer who just wants their money, the customer gets angry. So what does the bank's incentive push them toward? Slow it down, ask more questions, escalate the weird ones. That does not mean every delay is justified. It does not mean every bank handles it well. It does not mean the customer is helpless, but it does explain why a transaction that looks normal to you can look risky to the bank. The bank does not know your full story. It sees a pattern, and patterns are not always fair. A person who normally withdraws $300 and suddenly asks for $18,000 may be buying a car, or they may be getting scammed. The software does not know. The teller does not know. The compliance team does not know. So the system asks questions. That is irritating. But it is also why preparation beats anger. Call ahead. Ask what the branch needs. Ask whether cash is even the best way to pay. Ask whether a wire, cashier's check, or direct transfer would make the transaction cleaner. Do not walk in with a large surprise and then act shocked when the bank treats it like a large surprise. The next mistake is thinking cash is always the strongest way to pay. People still treat cash like it gives them control. Sometimes it does, but for large transactions, cash can make everything harder. If you hand a business more than $10,000 in cash, that business may have its own reporting duty. Form 8300 applies when a trade or business receives more than $10,000 in cash in one transaction or related transactions. The IRS says cash includes coins and currency, and can include certain cashier's checks, bank drafts, traveler's checks, and money orders with a face value of $10,000 or less in certain transactions. That last part is where people trip. They think splitting payment makes the form go away. It often does not. If the payments are related, they can still count together. The IRS gives examples where installment payments or related payments can trigger Form 8300 once the total goes over $10,000. So if you pay a contractor $7,000 today and $5,000 later for the same job, the business may still have to report it. That is not because the contractor hates you. That is because the rule follows the transaction, not your feelings about the transaction. And there is a useful detail here. A wire transfer is not treated as cash for Form 8300 purposes. Personal checks are not treated as cash either. The IRS reference guide says cash does not include a personal check, and it also gives an example where a wire transfer does not count as cash for Form 8300 reporting. That does not mean wires are invisible. They are not. Banks have records, but wires are usually cleaner for large, legitimate payments because the path is obvious. Source, recipient, amount, date, purpose. That is what you want. Not mystery, not cleverness. Not a stack of smaller payments that makes everyone wonder why you did it that way. Part 5. Now we need to clean up one of the biggest myths. Digital payments. This is where a lot of scary scripts go off the rails. They say Venmo, PayPal, Cash App, and similar platforms are all dropping to a $600 reporting threshold. That was a real concern for a while, but it is not the current federal rule. The IRS says the One Big Beautiful Bill restored the old Form 1099K threshold, so third-party settlement organizations generally do not have to file Form 1099K unless reportable payments are over $20,000 and there are more than 200 transactions. That correction matters because bad information creates bad behavior. A person hears $600 and starts panicking over normal reimbursements, dinner money, a birthday gift, a family repayment, a used couch, and then they start trying to hide normal activity from a rule that may not even apply the way they think it does. That is not protection. That is confusion wearing a fake mustache. The cleaner way to think about payment apps is this. Business activity and personal activity should not be mixed if you can avoid it. If you sell goods, take client payments, or run a side hustle, keep records. If your family is reimbursing you for pizza, keep that separate from business payments. The goal is not to hide. The goal is to make the story obvious if anyone ever asks. Crypto is different. The IRS now has Form 1099-DA for digital asset proceeds from broker transactions, and the IRS guidance says broker reporting begins with certain transactions on or after January 1st, 2025. Brokers report gross proceeds for transactions from 2025, and basis reporting begins for certain transactions from 2026. That is a real change. But again, the lesson is not panic. The lesson is records. If you sell crypto, trade crypto, or use digital assets in a taxable transaction, you need clean records. what you bought, what you sold, when, for how much, what your basis was. The boring spreadsheet beats the dramatic excuse every time. The common misunderstanding is that reporting equals accusation. That idea causes more damage than the report itself. A report is not always a warning sign. Sometimes it is just the system doing what the law tells it to do. The suspicious part is often the attempt to avoid the system. This is why the "just stay under $10,000" advice is so bad. It sounds like street wisdom. It is actually legal quicksand. If the money is legitimate, let the transaction look legitimate. Move the real amount. Use the payment method that fits the purpose. Keep the invoice. Keep the contract. Keep the receipt. Write down why you moved the money. And if it is a large transaction, talk to the bank before the day you need it. Not because you need permission to use your own money, because you want fewer surprises. There is a difference. Also, if you are older or you help an older parent, ask the bank or brokerage about trusted contacts.